Lots of people have different views, and you have to see Bitcoin as one pole, one polarity, and credit as the other. People that want to be completely without counterparty risk and self-sovereign, they want the commodity. But on the other hand, in your life, you buy things all the time from corporations where you rely on the company to perform.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comment section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Saylor starts with a simple but powerful idea. Bitcoin is a high-performance capital asset. Over the past 5 years, it has delivered roughly 38% annual returns, far outperforming traditional assets like gold, real estate, or equities. But there's a problem. Bitcoin is volatile. It behaves like a roller coaster, with major ups and downs and no steady income. So the question becomes, how do you turn that volatile capital into something stable and income-generating? His answer: convert capital into credit. Here's how it works. Bitcoin is treated as a commodity-like capital asset. That asset is then leveraged and over-collateralized. Credit instruments are issued against it, with risk stripped away. For example, if you over-collateralize at 5-to-1, the underlying Bitcoin could drop 80%, and the credit investor would still be protected.
And so our company strategy converts capital into credit. We take the BTC commodity and we convert it into a currency like the US dollar or the euro. We stretch its USD. We take the risk that's 1-for-1 and then we over collateralize to strip it away. If you collateralize something 5-to-1, that means that the capital asset can fall 80% and you're still fully collateralized. So the capital investor has lost 80% of their collateral. The credit investor is still protected. So you're stripping risk. When you do that, you damp volatility. The volatility of Bitcoin's been 40. We strip that volatility away when we strip the risk away by targeting a standard value. And from that, you extract a yield, a cash flow. And you do that while compressing duration. Instead of waiting a decade in order to get a capital gain, you get a yield within a month. And so the world's built on capital, the world runs on credit. We designed a lot of credit instruments, but after many, many tries, we finally discovered STRC. And STRC is built to provide the benefits of equity investors, like double-digit returns and tax efficiency, with the benefits that credit investors get, like low volatility and capital preservation. So if you can combine all of those together, you have the best of the credit world and the best of the equity world in a single instrument. Digital credit appeals to people that might like private credit. Private credit is the reach for yield. People that don't like money markets, they don't like investment grade bonds or junk bonds, they buy private credit. There's $3.5 or more trillion in private credit. But private credit's illiquid, it's opaque, it's heterogeneous, it's a portfolio of 1,000 private loans. It's discrete, it's restricted to qualified investors. There's a high fee associated with it. And we just saw in the past month that private credit markets have been melting down. They got hit with a rash of redemptions. They couldn't meet their redemptions. And yet it's $3.5 trillion of money that wants to invest in these instruments. Digital credit, it's liquid, it's transparent, it's homogeneous, it's scalable, it's accessible to everybody, and there's no fee. And so if you look at this, you could see that digital credit, even if it just transformed 10% of the private credit market, would be $350 billion in today's dollars. Digital credit's meant to appeal to lots of different investors. It's meant for retail investors. It's meant for digital native or crypto investors. It appeals to hedge funds and hybrid investors. It appeals to institutional credit investors. And it's also an appeal to corporate treasurers and CFOs that want to hold some high performance monetary asset on their balance sheet. A lot of people were surprised when we used the preferred stock to do this, but it turns out that digital credit is just the re-emergence of preferred capital after 100 years. If you go back to the 19th century and think about the last major capital development effort, which was railroads, most railroads and a lot of the early industries during the Industrial Revolution, they were financed by preferred stocks. It used to be 20 to 40% of the capital structure of corporations. In the 20th century, preferred stocks fell out of favor. It's almost like they were forgotten. And now in the 21st century, we've reintroduced the idea of preferred credit or preferred stocks back into the capital markets. Now, how do you create it? People always wonder, how do you create an 11% yielding credit instrument? Well, you start with the performance of asset classes. And if you look at the performance of Bitcoin over the last 5 years, it's up 38% a year, which is much better than gold or the S&P. Real estate's up 6% a year. Money markets are up 3% a year. You can't create a credit instrument that pays a dividend higher than the capital return of the capital that the credit's being invested in. So as you can see, the theoretical highest yield you could ever pay on gold-backed credit would be 16%. The theoretical highest yield you can pay on real estate credit is 6%. On the other hand, with Bitcoin, the theoretical yield is 38%. So if you think about the theory of asset-backed credit or the theory of digital credit, what you do is you take the capital gain you expect in the capital asset, and then you pay a portion of it to the credit investor. If you expect 30% in Bitcoin, you could pay 11% to the credit investor. The excess yield, in this case, the 19% yield spread between 30 and 11, that goes to the equity. And so the common equity investor gets the actual carry or the yield boost. The credit investor gets that first 11% strip of return with risk management principal protection. You could do what we've done in theory with gold, with real estate, or with the S&P index, but you wouldn't be able to pay as high a dividend because those asset classes don't perform as well. So here's another way to look at it. Bitcoin is something for people that want to hold for 10 years. It's a roller coaster. It's got 30 ARR. It's got 30 or 40 volatility. You're going to have years where you're up, years when you're down. You're going to have no cash flow for a decade. Digital credit simply strips the first 11%. You return it to the credit investor, and you get a very comfortable ride. Now, if you look at that chart, you see we're just doing signal processing on a financial signal. Where does the excess volatility go? Where does the excess return go? It goes to the equity. And so we created digital credit off of digital capital, and then that creates digital equity. As it turns out, all three of these assets are created with digital intelligence. We couldn't create digital credit without digital intelligence. So if you're looking for a killer application of AI, it's taking digital intelligence and working on digital assets or digital capital to create digital equity and digital credit. And you can see it at work here. In fact, we've done it with our own securities. So now, if you think about how this sits for an investor, if your time horizon is less than 4 years, if you need the money in a month or a quarter or a year, you probably want to hold the credit because you don't want any volatility in the principal. If you don't need the money for a decade and you don't want counterparty risk, if you want complete self-sovereignty, you should buy the Bitcoin, the commodity. And if you, on the other hand, have a long time horizon, but you want to bet on the future of digital capital and digital credit in an amplified way, you buy the equity, the digital equity instrument. Now,
once the risk is isolated, something interesting happens. You can engineer predictable returns. Bitcoin might fluctuate wildly, but by structuring the system correctly, the volatility, around 40%, is dampened. A targeted return is extracted. Investors receive a steady yield, for example around 10 to 11%. Instead of waiting 10 years for capital appreciation, investors can now earn monthly income, experience low volatility, preserve their principal. This process is similar to signal processing in engineering. The noise, volatility, is separated. The signal return is refined into usable output. The result is a new financial product that behaves very differently from Bitcoin itself.
lots of people have different views, and you have to see Bitcoin as one pole, one polarity, and credit as the other. People that want to be completely without counterparty risk and self-sovereign, they want the commodity. But on the other hand, in your life, you buy things all the time from corporations where you rely on the company to perform. When you get in an airplane, you trust the pilot to land the plane. When you buy an iPhone, you trust Apple not to turn off your iPhone. When you go to a dentist, you trust the dentist to not stop halfway through the operation. The world is full of examples. When you watch a Netflix series, you trust Netflix to let you finish the show. When you buy electricity, you trust the power company to keep pumping the electricity. In fact, I would say there's a lot of people that want unlimited free electricity. They do not want to install a nuclear reactor in their backyard. And so what's happened here is we have created a crypto reactor, and we're using it to create credit in order to serve a group of people that don't want to do this work themselves. They don't want to wait a decade before they actually monetize their investment. They want to consistently monetize the investment every month for 120 months in a row. Who would do that? A retiree, a 3-year-old, a 12-year-old, a conservative institution, a company that has lots of consistent bills, and if they don't make their payroll in 2 months, they get shut down. People that if they miss their bills, they go to jail, right? There are plenty of institutions and individuals and investors that can't stand, they can't take a long duration capital investment. For them, they need the credit. One serendipitous result we found while we were engaged in this was that if you finance the dividends from a credit instrument by monetizing an unrealized capital gain, you've created a return of capital dividend, and that's tax deferred. To the people backstage, the timer in front of me is not working, so I may very well go on forever if you don't turn the timer back on. Maybe they're being polite. That return of capital dividend's been around for more than 100 years. But it turns out that we were the company that figured out how to scale it by combining the credit instrument with digital capital. Now, how is it doing? This is Stretch recently. Stretch has grown from nothing to $8.5 billion in about 9 months. It's currently got $400 million almost of daily liquidity. Its volatility has fallen to 2.9%. The Sharpe ratio is the high 2s. It's 4x over collateralized. Here's another chart. This is hyper growth. How do you know that a product's working? Well, it's growing 350% a year. That's how fast it's growing. Like it's 100% month over month growth. So I don't know how long this will be in hyper growth, but right now this is the fastest growing credit instrument in the world, maybe in the decade or the century. Why is it growing so fast? Well, it's growing fast because it's ideal credit, because it was engineered to provide everything a credit investor would want if you look at it from the point of view of the investor, not from the point of view of the issuer, right? Most credit issuers want to create an instrument that's good for them, that's bad for the investor. We started with a blank sheet of paper using digital capital, then we used digital intelligence, and then we designed a credit instrument that's good for the investor, that's the ideal credit instrument. Now, how can we tell? The instrument grew to be the largest preferred stock in the world within 8 months. It's now $8.5 billion. I'm showing you the 10 largest preferred stocks. If you read the chart, what you'll see is that stretch is a simple thing to remember, STRC. The other stocks are C/PN or POW.PR.E. If you went and searched for these, you wouldn't find half of them. Like, you can't even Google them hardly. How do you buy them and sell them if you can't find them? They're actually institutional products. They were never meant to be bought. Some of them, the ones that say OTC, it's illegal for you to buy them, right? They weren't built for the public investor. They were built for an institutional world that traded credit in the 20th century. And so what's the result? Nobody trades them. STRC isn't just the biggest preferred, it's actually the most liquid preferred in the world in 8 months. Let me say that again, in the world, it's the most liquid one. It's not even 12 months old. Look who it's competing against. Wells Fargo, Bank of America, Fannie Mae, Citi, JP Morgan. It's 25x more than the next best one, and it's not a year old, right? It's like Superman as a toddler beating the crap out of everybody. And it's because it's Bitcoin powered, right? Now, if you delve a little bit deeper, you'll see that it trades 4.5% of its AUM every day. So it's not just that it's more liquid and it's bigger, it's actually faster, higher powered money. And it's higher powered by an order of magnitude. And so you can see the superior engineering design. Now, what else is highly liquid? Bitcoin. The reason digital credit is highly liquid is because digital capital is highly liquid and the digital equity is highly liquid. And it's not an accident. They're all correlated to each other. If you want to build the one, you have to build, if you want a high energy credit, you have to build it on a high energy capital asset. What else do you want from credit? You want it to be stable. And so you can see in the middle of the crypto or the bear market here in the crypto winter, Bitcoin peaked in October 6th. It was 125,000 a coin. It's 38% down. STRC is 0%. It's exactly held par. And so what you can see is that the credit instrument is something you can manage to hold principal value. And you need an issuer to do that. That's where the company comes in. The capital instrument has no issuer, no counterparty, no one's managing it. If you're a long-term investor, I would tell you every day, buy Bitcoin, don't buy the credit. But the truth of the matter is, most people aren't long-term investors able to take that volatility. They simply want to put their money in a bank account, collect 10 or 11% and not worry about it, let somebody else worry about it. And STRC is built for them.
Michael Saylor's vision is ambitious. To build a bridge between the high-growth world of Bitcoin and the stable, income-driven world of credit by combining digital capital, Bitcoin, digital intelligence, AI and engineering, financial structuring, preferred credit. He's attempting to create a new asset class, digital credit. If successful, this could reshape how investors think about yield risk liquidity